Hello everyone and welcome to Managerial Accounting. In this video we're going to start with chapter 23, which is about something called standard costs. So we're going to be covering evaluating variances from standard costs. So what are standards? Standards are basically some form of performance goals. So when we want to set our goals, we set a standard. Manufacturing companies normally use standard costs for each of the three following product costs. So we covered before direct material, direct labor, and factory overhead. This is where standard costs would not be applying. Accounting systems that use standards for product costs are called standard cost systems. Standard cost systems enable management to determine the following. The first thing is the standard cost versus the actual cost. So in other words, how much a product should cost versus how much it does actually cost. So one of the major objectives in setting standards is to motivate employees to achieve efficient operations. I want you to remember that. The main reason we have to set some standards is because we want to motivate our employees to reach that standard or maybe beat it. So we have something called ideal standards versus normal standards. So what is the ideal standard? It's like in perfect conditions, or in theoretical standards sometimes we call it. So these are standards that can be achieved only under perfect operating conditions, such as no idle time, no machine breakdowns, and no material spoilage. Such standards may have a negative impact on performance because they may be viewed by employees as unrealistic. And to a certain level, I think they are unrealistic. It's like the perfect scenario. It's like when you're trying to see how much your car can best consume gas, and you assume like everything would be perfect, like a flat road or something like that. It's not very realistic. We all drive in situations where it's very difficult to calculate the ideal consumption of the car. So the more realistic standard are the normal standards. So sometimes we call them the currently attainable standards, and these are standards that can be attained with reasonable effort. So such standards, which are used by most companies, allow for normal production difficulties and mistakes. Again, because be realistic, we don't live in a perfect world, so usually there are some errors, mistakes, production issues, things like that. And because of that, we have to set what we call them the normal standard. So standard costs should be periodically reviewed to ensure that they reflect current operating conditions, because things can change from one day to another, and because of that, the standard cost has to be periodically reviewed. Now let's see the criticism of standard costs. So standard costs, they have a lot of criticism. One of those is standards limit operating improvement because they discourage improvement beyond the standard. So people would try to just meet the standard, and that's what they hope for, or employees, or manufacturing employees. So because of that, it might limit any opportunities for operating improvements. Standards also can be too difficult to maintain in a dynamic manufacturing environment, resulting in what we call it stale standards. So stale standards where it's like getting to be far from reality. So standards can also cause employees to lose sight of the larger or the bigger picture or the bigger objectives of the organizations by focusing only on efficiency improvement. Because sometimes employees would ignore quality and just maybe focus on the efficiency. And it could be other objectives of the business. And they only focus on the efficiency and trying to meet the standards. So another criticism is that standards can cause employees to unduly focus on their own operations, possibly harming other operations that rely on them. So just focus on what you're doing, you want to meet your own standards, and you don't care about anything else in the business. So on the other side, standards are used widely and are only one part of the performance evaluation systems used by most companies. So let's go through a quick knowledge check to see if we retain something out of that. So the question here, which of the following is a major objectives in setting standards within a standard cost system? Is it making employees work as quickly as possible? Or is it producing as many products as possible during the period? or motivating employees to achieve efficient operations. I think we've seen that. And the last thing is firing managers who are responsible for unfavorable variances. So basically, the standard cost system, the reason behind it, or its objective, is to motivate employees to achieve efficient operations. So one of the major objectives in setting standards is to motivate employees to achieve efficient operations, as we just mentioned. Now let's talk about budgetary performance evaluation. So this is slightly intense, if I can call it intense, because we have to pay attention to the little details here, and we're going to build on it. And this is where we are going to see how we're going to evaluate the budgetary performance. So the master budget assists a company in planning, directing, and controlling performance. The control function, or budgetary performance evaluation, compares the actual performance against the budget. That's the main purpose here for the control function, or what we call the budgetary performance evaluation, is to compare our actual performance to what we had in the budget. So here we have a hypothetical company called Western Rider Incorporated. It's a manufacturing of blue jeans. They use standard costs in their budgets. The standards for direct material, direct labor, and factory overhead are separated into two components. They have the standard price and they have the standard quantity. So remember, in any kind of budget, we have to set the standard for the price that we are going to buy or to incur the material, the labor, the overhead, and the quantity that is going to be used for each of the material, labor, and overhead. So the standard cost per unit for direct material, direct labor, and factory overhead would be computed as follows. We're going to have the standard cost per unit to be equal to the standard price multiplied by the standard quantity. So let's apply that to the three components of manufacturing cost. So we have direct material, we have direct labor, and we have the factory overhead. These are the three components of manufacturing cost. So if we start with direct material, let's assume that for this company we have the standard price to be $5 per square yard, and the standard quantity per pair would be 1.5 square yards. So if we multiply the price, or the standard price, by the standard quantity, we get the standard cost pair of jeans, which is $7.50. Same thing for labor, but instead of having the price per yard, it's the price or rate per hour. So for labor, they charge $9 per hour, and the standard quantity per pair is 0.8 hour per pair. So if we multiply these two numbers, it's $7.20. That's the standard cost per pair of jeans in terms of direct labor. For factory overhead, it's $6 per hour, and it's 80 cents hour per pair, and that's going to be $4.80. If we add these three values together, that's $19.50. That's the total standard cost per pair of jeans. So what are the cost variances then? So the differences between the actual and the standard costs are called cost variance. So we compare the actual cost to the standard cost. The difference, we call them the cost variance. It's very similar to like saying cost difference. So a favorable cost variance occurs when the actual cost is less than the standard cost. Because keep in mind, we want to have lower actual cost in our production because that gives us the flexibility of having more margin profit or profit per pair of jeans that we sell. So a favorable cost variance occurs when the actual cost is less than the standard cost. An unfavorable cost variance occurs when the actual cost exceeds the standard cost. So remember this formula. If the actual cost is less than the standard cost, then this is a favorable situation. We call it favorable cost variance. If the actual cost is greater than the standard cost at actual volume, then that's considered to be an unfavorable cost variance. So now let's talk about the budget performance report. The report that summarizes actual cost, standard cost, and the difference for the units produced is called a budget performance report. So let's go to our example here. Assume that Western Rider Incorporated produced the following pairs of jeans during the month of June. So they have what they call XL jeans produced and sold, 5,000 pairs. the actual cost incurred in the month of June for direct material, and that's the total cost, total actual cost. 40,150 for the labor, it's 38,500, and factory overhead, it's 22,400. The total cost incurred, these are actual total cost, $101,050. So in the next slide, we're going to see the budget performance report. And the budget performance report would have 3 columns, or maybe you can have the first column here as manufacturing cost, or the details of the manufacturing cost, the 3 components, and then we have 3 columns that would represent the values. So the first column is the actual cost incurred that we just had in this previous slide, and then we'll have the standard cost at actual volume. So in other words, we're calculating the total cost based on the standard rates or prices multiplied by the actual volume. And then we get the difference between column 1 and 2 to get the cost variance. And if it's between parentheses, that's a favorable. If it's without parentheses, then it's unfavorable. So for direct material, you can see here that the actual cost was 40,150 based on the standard cost based on actual volume of 5,000 pairs of jeans. It should have been 37,500. So you can see here that that's actually unfavorable because our actual cost was more than the standard. So we have a positive value here, and that's an unfavorable situation. For direct labor, it was 38,500. That's the actual cost. The standard cost based on the actual volume is $36,000. So actually, again, we spent $2,500 more. That's another unfavorable situation. And then finally, we have the factory overhead. That was actually the only one that had some good news. So the actual cost was $22,400. The standard cost should have been $24,000. So actually, we have a favorable situation of $1,600. So if we add the total actual cost was $101.50. For the standard cost, the total should have been $97,500. So we have a total unfavorable situation of $35.50. Keep in mind how we got these numbers here. This was based on the actual production of 5,000 pairs and the standard cost and rate per pair for material, labor, and overhead. So this is how we got these numbers. So I want you to understand how the cost variance, the total manufacturing cost variance is broken down. So again, the total manufacturing cost has 3 components. The variance has 3 components. We have the direct material, direct labor, and factory overhead. So we have direct material cost variance, we have direct labor cost variance, and we have the factory overhead cost variance. In terms of the direct material cost variance, we have 2 types of variances. We have the price variance and we have the quantity variance. So differences in prices and differences in the quantity used in manufacturing. This is how we're going to get the variances. For direct labor, we have the rate variance and the time variance. The rate variance is how much the hour rate charged by labor, the variance in that. And the time variance is like how much is the difference between the standard and what actually the time used for manufacturing per item. That's what we call it, the time variance. So this is how we broke down the direct labor cost variance. And then for factory overhead cost variance, we have the variable factory overhead controllable variance, and we have the fixed factory overhead volume variance. So speaking of manufacturing cost variance one more time, the total direct material variance is separated into a price variance and a quantity variance. So the actual direct material cost, we have the actual price and the actual quantity. The standard direct material cost has the standard price and the standard quantity. So the direct material cost variance would be the price difference and the quantity difference. So the price difference is between the actual price and the standard price. The quantity difference is between the actual quantity and the standard quantity. So these combined together would give us the direct material cost variance. Speaking of labor, we don't have a price. We have actual rate versus standard rate, and that will give us the rate difference. And for the time used in manufacturing, the actual time versus the standard time would give us the time difference. These two together, the rate difference and the time difference, would lead to the direct labor cost variance. So let's see this last knowledge check here before we take a break and get to the next video. So it says here, which of the following is not a component of total manufacturing cost variance? Is it the direct material cost variance? Is it the fixed and variable cost variance? Is it the direct labor cost variance? Or is it the factory overhead cost variance? Again, remember, which one is not a component of the total manufacturing cost? In this case, it's the fixed and variable cost variance. We have the direct material, we have the direct labor, and we have the factory overhead cost variance. So the right or the only wrong answer here is the fixed and variable cost variance. The total manufacturing cost variance is the difference between total standard cost and total actual cost for the units produced. It's broken down into the components of direct material cost variance, direct labor cost variance, and factory overhead cost variance. Alright, so let me stop here. In the next video, we're going to talk more about direct material and direct labor variances and how we can break them down.